Well, hello and a very warm welcome to this webinar, What Lies Ahead for European Banks, brought to you by Scope Ratings. My name is Keith Mullin and it's my pleasure to be your moderator today and delighted to be joined by Marco Troiano, Scope's Head of Financial Institutions. Now, to turn this into a more interactive session, we decided to run this as a conversation between Marco and me. That is, me asking questions and Marco answering them, not the other way around. So what does lie ahead for European banks amid a number of moving parts, including uncertain politics and geopolitics, slow regional growth, and an easing monetary backdrop, just as banks hit the final stretch of road leading to Basel III? And of course, this session is very timely as we approach second quarter earnings season. The questions I'll be putting to Marco will cut across profitability, capital, asset quality, liquidity, and solvency. I'll also be delving into digitalization and a perennial favorite, consolidation. We'll be delighted to take your questions as well, so please do type these in as we go along and we'll get to them in due course. And at the end of the session, we've made available to download a couple of recent bank research notes. I'll explain how to download those at the end. So that's it from me. Hey Marco, it's great to see you. So let's get right into it. So wanted to ask you, before we get into banking topics, could you just lay out, in summary, the scope outlook on the global and European economies?
Yes, of course, Keith. First of all, thanks for organizing this, and thanks to anyone who connected ahead of the summer break. So just to set the scene, I think it's not a bad idea actually to review where Scope sits in terms of the overall macro view. Our macroeconomic council has published its latest update in mid-June. Our base case is one of a soft landing for the global economy and with respect to the European economy, a recovery. This is actually what we've seen in the first half. There are, I think, fears of European recession have greatly receded. First quarter was positive for most of the countries. So the idea that fast rising rates and the tightening of monetary policy over the past couple of years would have driven the global and European economies into spiraling recession seem to have been misplaced. Our expectation for 2024 for Europe is one of positive but subpar growth, so 1% GDP growth on average, and then picking up some steam in 2025 with 1.7% GDP expectation. What I think it's important to also highlight is the resilience of the employment picture, which has been, I would say, surprising in many ways over the past year. But also the overall debate around inflation and interest rates. We've held a view of higher inflation and higher rates for longer. This is a quite widespread view, but our macroeconomic council has been on it, I think, for a long time. Clearly, inflation has moderated from the high levels of 2022. But it does remain above the 2% targets, and we think that this last mile might actually be quite difficult to close. There are several reasons for that. We can go into the details, but probably this is more interesting for our head of the macroeconomic council to discuss. What's relevant here is that with this resilient economic performance and stubborn inflation, we do expect central banks to tread very cautiously. And therefore, the cuts that many were expecting last year in interest rates are probably not coming. We actually foresee only a handful of rate cuts for the ECB. We're looking at a terminal 3% at the end of 2025. So a much more nuanced view compared with what was consensus up to 6 months ago. this is very interesting because, for the best part of my professional careers, I've always seen interest rates going up very slowly and then coming down precipitously in a crisis. And this cycle looks exactly the reverse of that. So very rapid increase and very, very controlled easing over the next couple of years.
Okay, perfect. Thanks for that. And that's a nice seg into I guess the first question on the banking sector. Now, higher for longer rates is presumably good for banks' interest margins and net interest income, even though perhaps rates may have peaked. What's your perspective for this revenue line, just generally speaking?
We think margins have peaked. Essentially, the dynamic of net interest margin really boils down to the timing of repricing of assets and liabilities. And what we've seen over the past couple of years was assets repricing very fast and liabilities actually surprising us for how sticky their pricing has been in the market. So now we think that most of the asset repricing has already happened, while the repricing of liabilities is still ongoing. And if you add to that the need to replace relatively inexpensive central bank funding, TLTRO, with market funding, then you have basically a recipe for falling margins. Now, that is not to say that there is no room for growth in the sector at all. There are still, we think, some business models that can deliver revenue growth, especially the ones that are less reliant on net interest income and more reliant on fees and commissions. But again, it's going to be more a case-by-case basis. So if in the past 2 years we had these sort of rising tides which lifted the revenues of all European banks pretty much, now we're going to go into reverse. We're going to see this receding tide, and only a few banks will be able to grow their revenues from the very high watermark of 2023.
Yeah, that makes absolute sense. And then moving it to then, as I mentioned earlier, look, we're coming into Q2 earnings. What are your general expectations with regard to bank earnings and profitability? Perhaps you can do Q2 and even Q4 as a whole. Like I said, more director of travel.
I mean, I would say there are two main trends to watch. One is actually the dynamic of net interest income. So as I mentioned, we think it's peaked or it's peaking as we speak. So for Q2, I think we could still see a more positive dynamic. For sure, the higher for longer and the change in expectations around the policy rates and market rates will mean that margins can remain a bit higher. So they will decline, but probably not as fast as they would have otherwise. So to look at the dynamic of net interest margins and how fast net interest income comes off the peak, I think that's one of the main things to watch in the upcoming results season. And the other one is the dynamic of cost of risk. Of course, we can probably speak about that later, but we do think we are in a new asset quality cycle. The asset quality cycle has turned last year. NPLs are slowly moving up, so it is to be expected that we will see some increase in the cost of risk. So from the current very low levels, range of 10 to 30 basis points, we will probably move towards a more mid-cycle normalized range, which we think it's at 30-50 basis points. Yeah. So what does it mean for the bottom line? Our forecasts point to declining profitability already in 2024 at a very controlled pace. So European banks will remain profitable, very profitable, I would say. But probably we've also seen the peak of the ROEs in 2023.
Right. Okay. Absolutely. I was going to move on to asset quality a bit later, but as you touched on it with the cost of risk and the asset quality cycle comment, let me ask you, so the EBA risk dashboard, which is a very useful document in all sorts of ways, they did point to pretty material increases in NPLs from Q1, Q4, and also in Q1. Can you just talk a bit more about asset quality? You don't sound concerned about the direction of travel here, but just focus perhaps a bit more on those quite big increases, and perhaps you can refer to Scope's NPL heat map publication, which is out recently. What did that point to?
Yes, thanks for the opportunity to shamelessly plug our recent publication, which I invite everyone actually to download. This is based on EBA data and the EBA quarterly dashboard. It's an extremely helpful set of data that allows to not only look at headline formation numbers, but also monitor the trends in the different countries and in the different economic subsectors. So first of all, I would actually qualify your characterization of the increase. It's material. I would say not insignificant, but it's not something I'm losing sleep over. So when I look at the EU average, it touched bottom in the first quarter of 2023 at 175%, the NPL ratio. Today we are at 186% a year later. That's not, a precipitous acceleration. In the last quarter, it's true there has been quite a bit of new formation. I think it's 7.5 billion in new NPLs, but this is still a very manageable increase. I mean, if you look at the buffers that banks have built in terms of profitability, this is not something, from a credit perspective that worries us. In fact, my expectation is that things will get even more dynamic from here. So I wouldn't be surprised to see NPL formation, over 10 billion per quarter in the rest of the year. But even then, this will lead the NPL ratio, by the end of the year to still be below 3%. And, if you really push the assumptions and the stress levels, the end of 2025, which probably be the end of this formation cycle, you're still below 5% NPL. So, I mean, what I'm trying to say is that if we are looking for an asset quality crisis that is comparable to the one we had in the last decade, we'll probably be very disappointed. It's going to be very uneventful. So yes, new NPL formation, this is normal, I would say, in a business cycle, but we're not overly concerned. The other element maybe worth highlighting from our NPL heat maps publication is that you can very clearly identify a few trends, both in terms of country and distribution and sector distribution. So the increase is relatively broad-based, but it's not everywhere. So the first high-level trend at the country level, you have some countries where the NPL ratio is still higher than the average, and this is typically because of legacy. Still legacy from the European sovereign crisis. I'm thinking about Greece, I'm thinking about European periphery in general. So here you have higher NPL ratios, but falling. So you have NPL ratios that decline because the banks are still in the process of cleaning up their balance sheets. So they're still, in some cases, selling NPLs or entering NPL deconsolidation deals. And then you have, the opposite, the core countries where you're starting from an extremely low base and you're seeing some accumulation. And of course, this really pops up in the heat maps because you're starting from such a low base.
Yeah.
And the other one is on a sector level, and it's a similar story. You have some sectors which start from high NPL levels and are typically the sectors that were more heavily impacted by the COVID pandemic. So tourism, transportation, accommodation in general, and the NPLs are actually trending down in these sectors. And then you have other sectors which from relatively low base are actually moving up, and these are the more typical cyclical sectors such as construction, real estate, in some cases information and communication technology. So I think that dynamic is really interesting and partly helps understand why the increase is not as high as you would expect if you were maybe just reading the headlines about commercial real estate in Germany or in the Nordic countries.
Yeah. Okay. Yeah. Thanks for that. moving perhaps if I could, Marco, to I wanted to ask you on some regulatory supervisory topics. Um, so the first one, so ECB supervision is updating its methodology for calculating Pillar 2 requirements. I understand it's going to be for the 2026 SREP cycle. Without sort of going into huge detail here, but as a bank credit analyst, do you welcome the changes, and what's their real purpose?
I welcome the change. I think that, I mean, we will see what comes out of it, but from the communications we've seen so far, it all seems to point into direction of greater transparency into the settings of P2Rs. So that's I think that's good. It will allow market participants to better understand supervisory decisions, and it will also enable issuers to engage in a more constructive way, I would say, with all of their stakeholders with respect to this interplay between, you know, the supervisory dialogue, the SREP, the capital requirement, and what in the end matters to shareholders, for example, which is the capital distribution, how you manage your excess capital, and management decisions more in general. You might have, you know, situations where the bank and the supervisors know that there is a particular activity which carries a certain risk, which leads to capital absorption, but this information is not public for the rest of the stakeholder community, and that can, you know, lead to a sort of stalemate in terms of communicating around some investment or divestment decisions. So no, I would say it's a welcome development from a market participant and a credit analyst point of view.
Okay, excellent. And the other factor, which I think is a very interesting one, is that the ECB supervisors are also moving to multi-year assessments, so they can actually hone in on specific risk areas that are relevant at the time, and perhaps emphasize non-priority areas. And so, in my role as devil's advocate, do you have any concerns, Marco, that on the basis that they consider certain risk areas non-priority, that some risks might be overlooked?
Yes, I think the. I mean, my answer has to be more nuanced here, right? So, when you move from annual assessments to 2 years assessments or multi-year assessments, that removes some comfort that the supervisor is on the ball on everything, without question. Now, it is true that some elements of bank analysis or some elements of the SREP can be extremely slow moving. So reassessing them at high frequency might be a waste of time. Business model is a very good example. I mean, even ourselves, you know, we're a rating agency. Our methodology places a lot of emphasis on the business model. We go through this process of reassessing the business model at high frequencies, or at least annually. 90% of the time, that yields no change in our view and our rating of the bank, because business models don't change every year. So I would say, if the move to multi-year assessments for certain areas of the SREP frees up capacity, and that capacity actually allows supervisor to increase their control over risk, their risk focus, this is indeed a welcome development.
Yeah, okay, no, that makes absolute sense. And one of the other things that I think is, well, certainly struck me as being very interesting, is this change to make deposits super senior, i.e. senior to senior unsecured debt and insolvency. That sounds like, you know, quite a potentially important step towards completing the banking union. What do you think?
No, I agree. It does. It's. I mean, it's not an end point. I mean, first of all, we need to clarify this is still proposals at this stage, right? Yes. The whole CMDI package, which basically includes amendment to the BRRD, to the deposit guarantee scheme directives, and to the regulation for the resolution mechanism, is a proposal stage. So it might take some time for for this to be in legislation. But the direction of travel seems very clear. On all of the positions of the Commission, Council, and Parliament all point into the same direction. They do point into this super senioritization of deposits in all jurisdictions. Currently, there is no level playing field in Europe. You have several different waterfalls in the different countries. So I think that's a welcome development for the banking union, and it might even be facilitating the further discussions around EDIS, or single deposit insurance scheme in Europe, because in practice what it will do is it will make the scenario where activation of deposit guarantee schemes is needed even more remote than it is today. So you basically have to burn through the entire capital structure of the bank, including capital, AT1, Tier 2, senior non-preferred, senior preferred, potentially resolution fund, before you even get to the deposits. And in some of the permutations, in particular the one from the Council and the Parliament, the DGSs and covered deposits are even senioritized to the rest of the deposit base in it's defined as a multi-tier general depositor preference. So that should make discussions on single deposit insurance and more viable, I think.
Yeah, interesting. Well, one to watch for sure. Look, also, there's been a lot of focus on the last couple of years, actually, on the CMDI, the Crisis Management and Deposit Insurance Framework, to do with failing banks, and that's also being updated. Can you just, perhaps very given time, perhaps quite briefly focus on the CMDI update, any perspectives you might have?
Yeah, no, absolutely. I think this the update to the deposit guarantee scheme is one of the elements of this package. And the other one is actually amendments to the BRRD. There are, I think, a couple of things on the table, including a greater harmonization on how BRRD is applied. It includes, for example, a review of the public interest test, which is this crucial moment at the time of failure of the bank, where authorities have to decide whether it is better for the public interest to place the bank in resolution or to actually put the bank through normal liquidation. And the orientation is to actually sort of lower the bar for the public interest of a resolution process. This means in practice that more banks, including smaller banks, medium-sized banks, might be actually subject to resolution. And by the way, this is an orientation that we already see in the market. The number of banks subject to external MREL decision keeps increasing year after year. So I think that might lead to a further extension, basically, of the scope of application of the BRRD.
Yeah, absolutely. A quick one. I guess you've already covered this, but just thinking, this time last year, we're coming out of well, we call it the mini banking crisis now. I'm not sure we thought it was mini then, but I don't imagine you have many concerns. Or perhaps it's a leading question. Let me ask you in a more open way. Do you have any concerns about bank solvency across the entire sector, large as well as small and medium-sized banks? Particularly, and you referred to this earlier in your answer about asset quality. Especially, we've got a lot of concerns about commercial real estate exposures now.
No, not really. I mean, banks are very well capitalized at the moment. Risks seem very controlled. I think what we saw last year with Silicon Valley Bank and Credit Suisse cases were reputational and liquidity issues rather than capital and asset quality concerns. And to be honest, the European banking sector fared quite well in those circumstances. So I think it's very important that we draw the right lessons from that crisis in 2023, and that is no amount of regulation or capital can actually protect a bank from a liquidity run. I mean, that's the nature of the beast. Banks' liabilities are runnable, short-term liabilities are runnable, and this is because banks perform these very important economic function of maturity transformation. So someone has to do it. It's a dirty job. In the private sector, the banks are probably the best place to do it because of their size and ability to diversify the pools. And this is the reason why we regulate them and we supervise them. And part of this run risk has to be insured, and we insure it through deposit insurance. But the reality is that the scope of the runnable liabilities is a lot bigger. You have short-term debt in the wholesale markets, and you have uninsured deposits, and you need to have, essentially a public sector backing for this sort of risk. So in the form of lending of last resort from a central bank. So to me, the focus on the role of central banks in managing liquidity crisis is very important. And I actually haven't seen a lot of proposals outside of academic circles into strengthening the role of central banks as lenders of last resort. I think we will see more of that in the future.
Yeah, okay. You mentioned that banks, certainly in the EU, are as a sector well capitalized. And I mentioned in my introductory comments that we're now in the EU in that final stretch towards Basel III, where CRD3 is CRR3 and sorry, CRD6 published in the official journal and taking effect with exception of the FRTB in January. Do you have any brief comments on any additional demands being made in terms of minimal capital requirements with the latest iterations of the regulation and directive?
Yeah. No, I mean, this is not new. We knew that was coming. So Basel III is coming online starting in January 2025. It will not come online immediately. It will have an implementation period through 2030. So banks will have plenty of time to adjust. It will result in higher capital requirements, in particular coming from credit risk and the output floor. But this is well known by now, and it's also well known that banks have enough capital to meet these higher requirements. I think the latest quantitative impact assessment from the EBA pointed to essentially no shortfall of capital on the new requirement for European banks, or very small amount, like $500 million. So I don't see this as a very material risk, and you can see it in the markets every day. Banks continue to announce extensions to their buyback programs, which are authorized by the supervisor. So I don't think anyone has any serious concern about the capital position of these institutions.
Okay, so you don't expect distribution strategies to change, whether it's buybacks or dividends or any other?
No, in the near term, I think the capital story is fundamentally unchanged. So banks meet all of the requirements, including prospective requirements and impacts of Basel III, and they make some profit. In some cases, they make a lot of profits. There is very limited need to accumulate capital for growth. There is very little profitable growth out there, in my view, and the banks still trade at in many cases below book value, which means shareholders prefer to get cash back rather than seeing it locked up in what the market sees as an unprofitable economic venture. So I think we will see high distributions. In fact, we'll probably see the distribution story broadening. We've seen this year the Greek banks coming back to dividends. So I think it's becoming more widespread, at least in the near term. That's the picture. And of course, if it goes too far, it will increase risk for the bank. It will have a negative implication for our ratings, because this is at the moment, one of the factors which is supporting the credit profiles of the banks. So if the rundown is excessive, at some point we'll have to take some actions.
Okay, no, absolutely. I wanted to move to ask you about banking consolidation. We have seen a bit of not huge renewal in activity in country transactions, but politicians and policymakers continue to bang the drum about cross-border consolidation and how they support it. Again, this is a kind of multifaceted, perhaps session in its own right. But how do you see the M&A landscape, both domestic and international?
So we've, I mean, this is a topic that of course, we've discussed many times. We published our last comment in the aftermath of the BBVA Sabadell announcement this year. Our view for the time being remains that the cross-border is very, very difficult. The economics of bank cross-border consolidation is weak. It's essentially the lack of cost synergies that is hindering it. In the domestic markets, we do think that there is more room for consolidations in places like Italy, Germany, but also Spain and the UK. And the economic rationale is a lot stronger. You know, you have very obvious cost synergies from these deals, and you don't have any of the regulatory hurdles that actually hinder, you know, the pooling of resources that you have in a cross-border deal. So for the time being, I would say more of the same, more domestic consolidation, which is good and we welcome, limited cross-border. Perhaps, you know, in a few years, if deposit guarantee schemes harmonization and depositor preference harmonization continues, some of these regulatory hurdles will be removed, and that might unlock, you know, the next step, which might actually be the cross-border one. But for the time being, I don't think that's going to be a huge theme.
Yeah. Okay. One of the things actually that did come up in the updated capital requirements directive and regulation was this idea that supervisors are going to start to take a much more, I guess, assertive approach to pre-authorize mergers, acquisitions, divestments, and transfers of assets and liabilities, for material operations. At the same time, in parallel, we have competition authorities scrutinizing M&A from a competition perspective, so very different. I mean, do you have a just brief kind of perspective on the regulatory updates as it pertains to M&A? Do you think it might slow down or hinder activity?
Honestly, I don't think it's going to make a huge difference. It's already a highly scrutinized process, bank M&A. I mean, when you're acquiring a qualifying holding in a bank, you need to seek authorizations from the host supervisor. You need to seek, as you mentioned, authorization from the competition authorities. You don't formally have to seek authorization from your own supervisor in the European legislation, but I think in practice that pretty much happens, especially if the deal has an impact on capital. So I don't think it's going to radically change the status quo. It's going to be a bit more red tape, but banks are very used to this type of interaction. So I don't see it as something that will really affect the dynamics of consolidation in the sector.
Okay, understood. Okay, now jumping, if I may, Marco, to deposits. You kind of touched on this earlier already, but can you just perhaps recap? As the rate cycle changed, we did see the shift in deposits, certainly a shift from non-interest-bearing sight deposits into interest-bearing term deposits. And this was happening also, we had the TRO repayments going on as well. And there was a question about, competition for deposits. Can you kind of wrap all of those topics into perhaps some thoughts on generally about deposits and?
Yes. So that's one of the assumptions that goes into this view that net interest margins are going to shrink. The shift in deposit mix is a cost issue in the end. You're moving from non-remunerated to remunerated deposits, and this is actually still ongoing. Now, with the turn of the cycle of interest rates, this might be slightly less acute, but there is still, a big gap between 0 and 3.75 or 3% if we look 12 months out. So I think that's really what is driving. I mean, this repricing of liabilities. The TLTRO coming to an end, I think it's actually a positive development in a way. I mean, in the past, there was a lot of nervousness in markets about whether banks could even come off central bank funding without seeing, massive blows up. I think it was a very big topic before TLTRO3, when TLTRO3 in the end was launched, TLTRO2 was expiring. Again, for some time last year there was quite a bit of skepticism. The reality is that TLTRO has been repaid almost entirely. No drama on the funding side. Liquidity coverage ratios have normalized, but again they remain very high. So it's not a huge funding topic. I think more interestingly, and this is something that is perhaps sometimes lost to specialists, to banking specialists, is the interplay between the overall market liquidity and the actions of the central bank on its own balance sheet and the liquidity which is available for the banks. We've been in quantitative tightening mode for quite some time already, and this is going to continue. So while the interest rate cycle might have peaked and might normalize slowly, the quantitative tightening is continuing, and for every billion of reduction of the central bank balance sheet, it means that the private sector will have to absorb that billion in supply for typically government debt, but in some cases covered bonds or corporate debt as well. So this is, I think, what we're going to continue seeing, and that I call it indirect competition for deposits. It's not so much that the banks are launching a deposit war at the moment against each other, but we increasingly see sovereign issuers coming to market with very big placements targeting retail clients. That's competition for the deposits. And more generally, that affects the whole funding cost picture for European banks.
Yeah. Okay. Thank you. I'm going to move on to ask you. It's a kind of impossible question to in terms of getting a short answer, but I'm going to attempt. Look, it's no secret that one of the key kind of interest topics in banking has been digitalization, and it's clear that how quickly and effectively banks actually progress in this area can and will be a game changer. I'm also going to ask you about the impact of AI on banking. We'll come back and do a session on this separately, I think, another time. But just for now, can you give some thoughts from your perspective about what's going to define winners and losers in this digitalization race?
I will skip the AI question. We can try and ask ChatGPT later, but I have my doubts that the answer will be satisfactory. So on the digitalization, so I think this is something we've been looking at for a while. It's super important. It's a conduit for cost savings, but it's also a conduit for effective competition, which is not price driven. So to me, these are the two main topic is how well and how fast the banks are digitalizing their processes, so their back office, middle office. And then the second one is what's the customer experience? What's the digital customer experience? We know that customers want to interact through digital channels. The branch is probably not dead, but it's also not very healthy at the moment as a distribution channel. And what does it mean for the competitive dynamics? So one, I think to succeed in this what I call digital arm race, first of all, large banks have an advantage. And the advantage is scale and the ability to deploy a lot of money into their IT development, but also to transfer knowledge and technological stacks from one part of the business to the other one. And we have a few examples of that, of banks in Europe doing it very successfully between developed Europe and emerging markets. I'm thinking about Santander, BBVA types. At the same time, the nimbleness, the capacity for fast adaptation is an asset. And this is something that large banks, by definition, cannot have. So I think it's very important that banks think strategically, and I don't want to sound like a management consultant here, but where they want to position themselves basically in the commodity product versus high value added product spectrum, or even in the banking as service niche. and also on how they go about acquiring the technology. So do they make it in-house? Do they buy fintechs? Do they partner with fintechs? One of the approaches that seems to be quite successful, and we're seeing more and more banks adopt, is this um, greenfield versus brownfield, where you have a large bank being run independently, and then you have smaller units that try to develop as neobanks inside, or under a bigger umbrella. And when the technology is mature enough, you have some takeover of customers and shifting of customers from one bank to another, which with enormous cost savings and in many cases better customer experience. So I think that's a little bit the winning strategy at the moment, or what seems to be the winning strategy that we're observing.
Yeah, okay, interesting. Just conscious of our time, Marco, I've just got maybe a couple of, I guess, kind of wrap-up questions. Can you just outline from your perspective what you see as key challenges confronting European banks today? And how comfortable are you that they're in a good position to surmount those challenges?
So we've touched on some of them. I think the standard set of risks that face banks are well under control. So you have this asset quality cycle, very manageable. Lack of growth in Europe in the medium term, but it's not a credit issue. Banks don't need growth if they're well managed, conservatively managed. The worry on structural levels of profitability has receded recently, but I think if you look through the cycle, it's still a question mark whether this is a sector that can earn their cost of equity, and that depends a lot on what people think the cost of equity is. But frankly, these are not they don't strike me as unsurmountable problems. The climate risk topic is not a near-term one, but potentially a very serious one for banks. There's a lot of focus from supervisor on it. I see this as a more difficult one to manage. So banks are doing a lot. They're investing a lot to map the risk, to monitor the risk, to monitor their exposures to the different risks, and to manage it. But in the end, the underlying economy also has to move, and it seems to me that some areas of the economy might be moving a lot slower. So the risk there is that instead of having the banks perform the utility function of greening the economy through financing, which is what our politicians want, it could also happen that we end up shrinking the banking sector to the size of the greenable economy, and that wouldn't be good for the banks or the economy, because that risk will still be there and will just be pushed out into the shadow banking world, which is less easy to control and less easy to steer from a policy perspective. The other one is geopolitical risk. Of course, we can control and we can manage our ratings to incorporate realized geopolitical risks. So exposure to places like Russia, Ukraine, Israel, that's not difficult for us to do, and we do it. But can you capture it ex ante? So from a credit perspective, this is something I think about a lot. In the context of a view of the world where the unipolar geopolitical order is probably giving way to something else, and it's not yet clear what in terms of new geopolitical order. So in the context of the US pivoting to Asia, reorientation is foreign policy. What does it mean for Europe? What does it mean for European banks? And how do we capture that? We have in our methodology an obvious place for it. It's the operating environment, but quantifying the impact is very challenging. So I think it's something that remains very qualitative at the moment in our analysis, but something that we should be looking at more.
Yeah. Okay. Thank you for that. I've got one more question for you, Marco. Before I ask it, if anyone has any urgent last questions that they wanted to put to Marco, please type them into the questions tab, the box, and then we'll take them. Otherwise, feel free, incidentally, to also circle back to us afterwards if you wanted to ask a question later, and we will respond to you one-on-one. So, Marco, my last question is this. So, back in January, you wrote a European Banking Outlook 2024. And now here we are in the second half of the year. I was wondering if you had to write one today, what would the key differences, if any, what would the key differences be between what you wrote then and what you might write now? And if I can ask you as well at the same time, can you, as a rating agency, can you talk about ratings migration over that period as well?
Yes, thanks for the question, Keith. I mean, I was actually planning to write a mid-year outlook update and then decided not to, essentially because our view hasn't changed enough to justify the effort. So I would say we largely stick to our calls from January, which is picking profitability, capital and funding normalization, and this moderate gradual increase in NPLs. I would say our expectations have mostly realized. The economic performance is in line with our initial expectations. In fact, if anything, the economy has been a bit more resilient than we had anticipated. Of the downside risk that we were flagging, none really has materialized. So we haven't seen any large recession in the European countries. We haven't seen crazy competition for deposit or deposit wars. We haven't seen any incremental market or geopolitical shock. The market has actually been very strong. And if I had to point to something on the positive, on the upside, we have seen an acceleration in the legislative process around the CMDI, which I think is quite welcome, as we've discussed. So that's medium term. This is a positive element if it actually leads to a full banking union at some point. So I would say the balance is positive. Now, to the second part of your question on rating migrations, our ratings have been very stable in the first half of the year. We have changed a few outlooks with a positive bias, so typically from stable to positive. And these were cases where essentially we thought that the banks were capitalizing on the positive external and favorable external environment to address some legacy issues and build the basics for stronger capacity to generate earnings over the medium term. So typically, using the increase in revenues to finance cost restructurings and to actually get out of previously unsustainable cost structures. Yeah. I would say that's the main type of positive rating actions we've seen in the first half.
Okay, perfect. Okay, that's a great place to leave it, Marco. So wanted to end the question and answer session here. So thank you so much for your very insightful answers. And thank you, everyone, for watching and staying till the bitter end. I hope you found that useful. I mentioned at the beginning that there's a couple of downloads we have made available. So if you click on apps at the bottom of the screen, and then you see handouts will pop up, click on handouts, and there you'll see two PDFs to download. One is the Bank Capital Quarterly that was published very recently, and the other one, as you mentioned, is the NPL heat maps note, which actually has a number of different heat maps covering different areas that hopefully you'll find interesting. So download both of those. And while you're doing that, I wanted to mention that we will be coming back at some point in the year, not during in midsummer, but later in the year, with some additional sessions. We do these sessions as an outreach to market participants and market stakeholders on topics that we think are of interest to investors and other participants. So look out for those. Just leaves me to once again thank everyone, Marco, and for our viewer for watching, and we'll see you next time. So it's goodbye from us.
Thank you very much.